So how does real estate depreciation really work? Do you want to reduce your taxable income without spending a dime? That's the power of real estate depreciation. And in this video, I'm going to show you how to do that. Most real estate investors know that depreciation helps offset taxes, but they don't really understand how it works. I'll break it down in this video so you know the advantages of real estate depreciation and how to maximize the benefit. If you own real property now and you plan on buying more, then understanding real estate depreciation is critical to being a professional investor. Stick around. I will show you how depreciation works, what you can do to maximize it, and how it ultimately saves you on tax. So what the heck is real estate depreciation? Depreciation is a non-cash expense that the IRS allows you to expense on the property in the hope that the future you're saving money by not paying tax using that expense to upgrade the wear and tear that happens to your property. The IRS knows that the parking lot is going to get worn down. The roof is going to have damage. Different aspects of the building need to be upgraded. So that's why they give American taxpayers this bonus allowance or this depreciation allowance, which is a phantom loss. You're not technically losing money on the property, but you're allowed to write off a significant amount of the income that comes in by utilizing the depreciation expense. So that way in the future, you will improve the property and not pay tax in the short term, hopefully long term, paying for the improvements when the time is right. So to be clear, depreciation is not a real expense. It is a phantom expense and a paper write-off. It just reduces your taxable income, but your cash flow does not change. So what type of properties qualify for depreciation? Rental property, residential and commercial. Improvements, so building structures, anything built on the land, but not the land itself. You cannot depreciate land. Buildings used in a trade or business. So if you own your own business and you have buildings, that is a depreciable asset that can reduce income. So what is the straight line depreciation schedule? Well, that is 27 and a half years for residential property and 39 years with commercial real estate property. What does that mean? Well, let me give you a case study right here. Let's look at a residential house that is valued or you just purchased it at $500,000. The land value on the tax assessor record is $100,000. So you have $400,000 of buildings or improvements on that property. The annual depreciation allowance for that residential property is going to be $400,000, which is the actual building improvements, divided by 27 and a half years, which is the straight line method of how much you can depreciate each year. This totals $14,545 a year that you can write off as a phantom expense on your P&L. Now, this $14,500 and change is deductible each year for 27 and a half years, and after that period, it runs out. So let's touch on cost segregation studies and bonus depreciation. How do you accelerate that depreciation where you can write off more than $14,545? So in order to accelerate the losses, you hire a cost segregation expert. They're going to look at all the components of the building, and then they're going to divide them out into different buckets. And in those buckets, there's different depreciation schedules. Now you're not subject to 27 and a half years as the average amount of time or the years or life that you depreciate the asset. You're going to have different components like the roof depreciated over 10 years, a parking lot, 15 years, different aspects of the building like carpet, fixtures over 5 years. And then you're going to come up with a new schedule of what you can depreciate early on in the investment. With bonus depreciation, you can accelerate the majority of the depreciation in the first 5 years of owning the asset, which then gives you large losses that will help offset all the rental income that you generate on the cash flowing property. This is a major strategy for real estate investors, and the IRS forces you to take depreciation. If you don't take it, you still will be taxed on it. So you have to utilize it in order to get the benefit. And they use it so that they are not paying tax on their rental income. They're deferring that tax down the road. So what happens when you sell a property? So there's no free lunch. You do need to pay tax. When you sell an asset, there's something called depreciation recapture. This is where all the depreciation that you've accumulated over the life of owning the asset now is taxed at 25% on the federal level. But there's an option. You can use a 1031 tax-deferred exchange where the profits from that property could be reinvested into another like-kind property. And I'm going to get into that in future videos. It's a excellent strategy for real estate investors to continue to defer tax. So to be clear, when you utilize a 1031 exchange, you are not paying the recapture tax on the depreciation. You are buying a new property and then deferring that tax down the road. One key tip to be aware of is the basis in your property that you depreciated down to does get moved in and transferred to the next asset you buy in a 1031 exchange. So you do not have that benefit of getting additional or more depreciation out of the asset that you buy, but you do defer all the capital gains that you received by selling that original property. We're going to get into that more on the next video. So now that you know how depreciation works, we're going to focus on 1031 exchanges, how to maximize them to generate the highest return on investment, the do's, the don'ts, and the things that most investors don't know so they can execute on a tax-deferred investing strategy.